Okay. Good morning. So the issue that I will discuss in this presentation is the concern in India that for some time from 2012-14 onwards, the private investment has been slowing down. So this is the structure of the presentation. Let me start with the presentation. So, what determines private investment decisions of the corporate firms? So that would firms generally try to make their investments efficient to improve operating performance and seeking growth opportunities. There could be numerous factors that affect firms' investment decision. One could be macroeconomic factors. Second could be firm characteristics. Third could be profitability. Now, studies on India empirically show that private investment is a key driver of economic growth. Gross capital formation, which is a measure for investments, that's gross capital formation as a percentage of total stock of capital stock is investment. Now, in the percentage of GDP, it has remained on an average around 36.29%. It peaked to 40%, above 40% in 2010 and declined. Now, so our scope of empirical research is that first to see the factors that affect slowdown of private investment. Second, how firms' profit impact on their investment decision. We use annual data from 1992 to 2018 across 5 industries: manufacturing, mining, electricity, construction, real estate, non-financial services. And we take farm level data from Center for Monitoring Indian Economy, farm level data. So in each of the sector, the farms, registered farms, private corporate farms vary from 1,000 to 5,000. And in manufacturing, it exceeds 10,000. So we collect a panel of both cross-sectional and time series panel. We construct a balanced panel. Then we take consider industry-specific characteristics such as investments, and for profit we take return on assets as a measurement profit, domestic demand growth, export growth. So domestic demand growth and export growth together becomes aggregate demand growth. Then gross value-added growth. Then so therefore, once we construct a balanced panel data, it encourages to employ pooled mean, group, autoregressive, distributive lag models. The specific of this model is you can estimate both long run and short run relationships. And also this model, I will discuss later why we choose this model. And this model actually has also ability of giving unbiased estimators and efficient estimator when you have variables which are co-integrated and some are stationary, some are co-integrated, and at their first difference, they are stationary. So in that case, the pooled mean group ARDL model is a better one. Now, before we go to the empirical exercise, let us look at a descriptive statistics to highlight the issue. First is you can see this from this chart that there is a secular slowdown of private investment over a decade. Investment and appears to be the most volatile component of GDP. Now, so the basic macroeconomic model that we study in graduate level course talks about the flexible accelerate model, which is the firms close a fraction of lambda, that is a fraction of their capital stock during a period. And real interest rates are calculated is call money market rate, that's the market, shortest market rates, and minus the inflation measured by wholesale price index. And the real interest rate in literature consider one of the factor that influences desired capital stock K star. Now you can see that real interest rates are rising because wholesale price inflation declined sharply, and that corresponds with investment slowdown. What could be other regions? Now you could see productivity of capital in India also has gone down. That is reflected through increase in incremental capital output ratio. The basic celebrated Harantoma growth model in macroeconomics would suggest that growth rate is I by K. I is investment rate, K is the increment capital output ratio. We also have seen in India the capacity utilization by farms across sectors on an average has gone down somewhere just about 100% to around 60-62%. Now, what finances investment? What could be the other reason? General gross domestic savings historically in India played a key role in financing investments. So we could see that lower investment growth periods also characterized by low savings periods in India. There is a significant fall within gross domestic savings. The household savings have significantly declined from 25% to 17%, and that coincides with the fall in private corporate investment. Why we pick private corporate investment? If you look at this distribution of investments across sectors, you could see that private non-financial corporations investment, that is private corporate sector firms investment, and households combined 70% of the total investment. Whereas even when gross capital formation has declined, that is total investments as a percentage of GDP declined, but it is the private non-financial corporation or private corporate investment has increased. So their share is substantial. Therefore, we focus on what determines private firms investment behavior. So to locate whether there is a stress in the private sector and the emergence, we divide the entire period into three sub periods. First period 2002 to 2008, it is characterized by the higher profit margins until gross fixed until global financial crisis hit. So investment slowdown derailed the economy thereafter. 2009-13, even after a slowdown, but it has seen a period of medium profit margins across sectors by firms. Whereas 2014-18 is characterized by low profit margin and a fall in private investments. Now, just to review the literature so that to come for an analytical model, generated model. So starting from classical economy, Smith and Ricardo, we could see that in income generated from the past production and sales considered to finance investment, where workers do not have the surplus in savings. Therefore, it is only from the income generated from the sales are a conduit for investment. Then, so realized profits determine the level of investment. Kaleki in 1933 for version 1 anticipated gross profitability and real interest rate. Investments are driven by the anticipated gross profitability versus real interest rates. Keynes also suggested aggregate investment is pushed to the point where marginal efficiency of capital equal to ruling rate of interest. Marginal efficiency of capital is the return on investment, and ruling rate of interest is the cost of capital. So Kaleki again revised his model. That's version 2 takes development factors, cash flows, and the investments are negatively related to the capital stock gap. If gap is lower, investment will be lower. If If gap is higher, investment would be lower or otherwise. The neo-Keynesian accelerator investment function, mainly led by Samuelson, uh, established a relationship between consumption gap over time, and which that's the demand, change in demand that will determine investment. Output accelerator model by Harold, Hicks, and Klein together suggested that the income, GDP of current period and the past, or current period or the future, the change in income levels will drive investments. So new classical investment by Brainerd, Tobin, and Tobin 1969, Jorgensen 63, all would suggest for emphasize the uh, desired capital stock in time period T minus 1 versus time period T. That's over time, the gap between the desired capital stock will determines investment. Profit theory or financial theory of investment emphasizes the role of profits, undistributed profits or retained earnings to the corporate sector is a major driver for investment. And there are also other financial variables like return earnings, cash flows are considered. And economic policy uncertainty also delays investment decision, therefore also influences level of investment. So in some macroeconomic variables such as demand growth, profitability, and economic policy uncertainty influence firms' investment decision. So based on review of literature, we construct the economic the data specifications. Then we consider the rate of asset return on assets as a measure of profitability. Then consider other factors and take the farm level data across 5 industries. Now, our model specification is investment is a function of ROA, return on asset, that's profitability, demand growth, export growth, gross value added, and EPU. And we take a parameterized auto-regressive distributive lag model with error correction model of the original ARDL model and specify accordingly. So the empirical findings, starting with correlation analysis, suggest that the model is free from the problem of multicollinearity. We check for the multicollinearity and it is free from that. Then we construct a panel-based unit root. We carry out panel-based unit root tests employed by Levin, Lee, Chu, Pesaran, Sid, and Fisher. And we find that demand growth, export growth, gross value added are stationary at level, whereas investment, return on assets, and EPU are stationary at fast difference. Therefore, we construct a balanced panel considering both fast difference and level. Then we carry out panel co-integration techniques suggested by Pedroni, and we calculate or compute 7 statistics, four for panel and 3 for the group. Then we reject the null hypothesis of no co-integration based on these 4 parameters out of total 7. Therefore, we find that the variables are co-integrated. Therefore, once the variables are co-integrated, the panel ARDL model has an error correction. Yes, I'm into the final findings. So the panels have been constructed, and the findings are that and before the findings, one why you consider to consider an appropriate economic model, we also carry out Hausman test. Then we find that we conduct a series of Hausman tests to select best estimator. We find that PMG estimator is preferred more than any other estimator. That's why we choose PMG ARD model, pooled mean autoregressive distribution. So our findings are very some are reflect what existing studies have found, and some are interesting. The profit in long run elasticity, so the profit matters significant and positive in the long run in affecting investment. Demand growth not significant in the long run. Exports growth and gross value added are positive and significant. So both together implies that aggregate demand growth is positively impact investment, but weakly. Economic policy uncertainty is expected negatively impact investment. In short run, profit is negative but significant. That means short run, the firms may be distributing away their profits. Therefore, that may not be influencing investment positively, which is interesting there. Demand growth becomes significant. Then we find a negative coefficient for, and we suggest a error correction model. These are the detailed results. So finally, short-term sectoral impacts. If you see, firms' investment decisions are influenced by different sectors and they vary across sectors. That means various factors influence various sectors differently. Export growth positively impact on investment in mining, construction, real estate, non-financial, but negatively impact investment in manufacturing and electricity. So the summary of the finding in lieu of conclusion is that we analyze factors affecting domestic private non-financial corporation investment behavior. Factors influencing investment vary in both in the short run and long run across industries, while profitability is the most important factor influencing investment in the long run. But demand growth, interestingly, is the most important factor in the short run. Export growth, gross value added growth are positively impact investment in long run. Economic policy uncertain and negative. So if we sum up the findings, and they are very interesting, they could be useful for policymakers who are concerned with to kickstart the investment cycle in India. Interestingly, in India, we have a high unprecedented foreign direct investment in last 1 decade, whereas domestic investment is lackluster, growth is lackluster. So therefore, these findings could be useful. That what is does it say? Cyclical investment downturn can be reversed by spurring aggregate demand change, that is demand growth, whereas prolonged structural slowdown in investment can be reversed by enabling firms to accumulate profits in the long run. Thank you so much. I look forward for your questions or queries if you have.